So how do we understand what happened with someone like, oh, this is the exciting stuff now, someone like Sam Bankman-Fried, which I know everyone who's watching knows who that is because he's been all over the news for the
Oh
last
yeah.
2 months, right? It's quite like a crazy story about him and his partner and just all of the crazy
Yes.
things they were doing. But yeah,
They're
how do
gonna
we
make a movie on this at
yeah,
some
they
point.
of course. But like how do
Um,
we understand what happened with with a figure like Sam Bankman-Fried and his FTX in the context of what we've been discussing?
so I mean, it's I mean, the rise and fall is truly spectacular. I think I mean, his empire was worth like 36 billion or so about, and and it kind of tells you. I mean, everyone kind of the con is kind of mind-boggling, and it kind of reveals the Ponzi nature of crypto finance.
Hello, everyone. I'm Rania Khalek, and this is Dispatches. Digital currency is so confusing. There's things like Bitcoin and Stablecoin and Tether and blockchain and Coinbase and Binance and Ethereum and Luna and Celsius and Circle and FTX and NFTs. The average person has heard these words and understands they have something to do with the world of cryptocurrency, that privately created decentralized money that doesn't really make sense or have any real value to most of us. It harkens back to 2008, when people tried hard and failed to understand derivatives. We know they were ultimately bad at the time and intentionally complicated, so no one would notice that they had the potential to crash the economy. It's almost as if this crypto stuff is also intended to be confusing and only comprehensible to already rich and powerful people who know how to make loads of money off of it, while rattling off some utopian ideals about the democratization of finance, while they speculate in an unregulated crypto Wild West. So, what's all this crypto jargon really about? What stage of capitalism does it mean we're in? How has it been affected by the pandemic and the war in Ukraine? What are the geopolitical implications for the US Cold War with China? And what's the significance of the downfall of FTX and Sam Bankman Fried? Could we see an even more dramatic unraveling in the crypto world in the future? One that spills over into the rest of the economy? To discuss this and more, I'm joined by economist Ramaa Vasudevan, an associate professor at Colorado State University and author of the recent monthly review piece, Crypto Convulsions, Digital Delusions, and the Inexorable Logic of Finance Capitalism. But before we jump into it, be sure to hit the subscribe button and the bell so you get a notification whenever we post new content. And if you appreciate this show, you can help it grow by becoming a patron at patreon.com/breakthroughnews or by donating below on YouTube. Ramaa, welcome to the show.
I'm happy to be here. Thank you for inviting me.
Well, it's so good to have you on. I really was so impressed with the piece that you wrote for Monthly Review, and I have so many questions for you. And I guess a good place to start is I think a lot of people, including myself, who aren't economists or understand digital currency, get very confused by all of these different terms that we hear when it comes to cryptocurrency. So maybe we can just start by, can you just lay out, like in layman's terms, for people who don't really get it, like what is cryptocurrency, and then we can go into more details from there.
Sure. I mean, the simple kind of fact of the matter is cryptocurrency is just a financial asset, but it's a digital financial asset. And while conventional financial assets have, let's say, their reputation or the capital of a financial institution backing them, you could have, let's say, the imprimatur of a credit agency saying, okay, this is a good instrument, this is a bad instrument. Here, I mean, the idea of crypto is you kind of dispense with a financial institution being the mediator, and it's basically decentralized. And what you rely on instead of the clout or reputation or resources of a big bank is cryptographic proof. So code, algorithms. That's what gives you kind of security, and you use open source kind of software systems to decentralize it. So, I mean, the history of transactions is recorded at the same time across all these ledgers. And once it's recorded, it's immutable. You can't change it. So that's what gives it, trust. So, I mean, that's the short thing. And there's all this kind of talk about this being an alternative payment system. It's money, but given that all these assets are generally very very volatile, they really haven't made a headway as being used as currency to buy and sell stuff. It's very niche, and
Hmm.
I mean, and while this has gone beyond the dark net and money laundering, it is, I mean, it can be used, it's being used more. It is still very very niche. What it is a store of value. It's something whose kind of price gyrations allow you to make or lose money.
Thank you very much. I appreciate that explanation. And then I guess from there, this is more related to what I wanted to talk more with you about is, where did crypto emerge from, and exactly when did it emerge, and why in that moment specifically? Because you talk in your piece about the significance of
Yeah.
2008.
Yeah, so you could say, the 2008 was a moment when banking came into kind of and what's called shadow banking came into the spotlight. And what was discovered when Lehman collapsed in 2008 is that um, the banks have built up a lot of have created a lot of assets on the basis of very small narrow base of capital, which means they're leveraged. They are kind of creating all these kind of liabilities, but they don't have the capacity to make them good when push comes to shove. And that's what happened with Lehman. That's what happened with a lot of the other kind of financial institutions when the subprime mortgages market collapsed.
Right.
And that meant there was this whole architecture of which financial architecture which has been built on pushing subprime mortgages, making creating a market for them, and creating layers and layers on top of it, so that basically the risks were supposed to be kind of uh, they're supposed to have evaporated while this really liquid kind of liabilities were being created. But when that happened, the Fed had to step in. The Fed stepped in, what's called quantitative easing. It kind of pumped money into the system, and suddenly it was quite evident that the Fed's response had a disproportionate effect. It's helping the banks, not so much the foreclosed house owners. So there was, the fact that um, the Fed can pump liquidity, and that this pumping of liquidity has kind of unequal impacts in society became really clear. Now, so banks went distribute, and um, though of course they continued to make a killing, and they got golden parachutes and all of that. But that's the context when this white paper is kind of written by this anonymous, so far unknown person called Satoshi Nakamoto, which proposed Bitcoin. And the idea was, let's create something which doesn't need big banks, which doesn't need big state, something which kind of empowers people. It was supposed to be a democratic alternative. It was something, uh, and so this is how Bitcoin was supposed to be launched. And given that Bitcoin would have a kind of a limit to the number of coins, it was also supposed to be inflationary. You didn't have this arbitrary kind of use of this money making capacity by the Fed, for instance, to pump. So there was this idea, and it was decentralized because basically you'd be coding, and codes would protect it. The downside, of course, was this coding required a lot of energy, and it's really energy guzzler. So this cryptographic proof is what validated transactions, and once validated, these transactions enter into the blockchain and a kind of a distributed ledger, which can be seen on by everyone anywhere in the world who is hooked onto that at the same time. So the origin was the crisis and this idea that we need something which is less prone to being manipulated by the state and finance. And look
Which
where we reached.
and look where we are, right? Exactly. And so that's like that's a good segue into the next thing I wanted to ask you about. I mean, you write in your monthly review piece, and I'm quoting you here, there is an inevitability to the convulsions seizing the world of crypto assets. So why
Mhm.
is that so inevitable?
This is inevitable because it's the nature of finance. I mean, finance has I mean, you cannot have a capitalist economy without finance. It's the lifeblood. But the nature of finance is that it's continually trying to, uh, push against barriers, increase. And once finance is also linked to this whole profit motive, so you're also trying to make returns, and you're searching for new sources of returns. And that engine makes finance into something which is both kind of fueling kind of accumulation, but it's also concentrating. It's also fueling inequality. Second, by by giving elasticity to the system through financial innovation to keep creating more liquid assets. So let's say a 30-year house mortgage is kind of transformed or transmuted into a CDO, which can be sold, you know,
Mm-hmm.
just like that. So that kind of alchemy basically also creates instability, because at some point, and that's instability is the kind of a variant of the bank run. The old
Right.
bank run is when depositors would basically be asking for their money back.
Mm-hmm.
Uh, the Lehman bank run was when those who had invested short term want their money back, and you're not able to roll over your short term liabilities. And the same kind of Achilles heel is there in crypto finance. Technology does not provide you an out.
So it kind of sounds like capitalism is the problem here. Like when you talk about finance being the problem, it doesn't really matter the mechanism that you switch
It's
to.
it's uh, it's inextricably linked to capitalism's need for this fuel, because
Right.
if you're constantly growing, you need basically the finance to fund that, and the machinery which you evolve to do that is susceptible to instability. What Minsky called the inherent instability of finance. So when the going is good, you keep pumping, and then suddenly um, things start kind of turning sour, and that same machinery, which is working so well, suddenly grinds to a halt.
But then, of course, there's this other aspect of cryptocurrency specifically that is different from the traditional finance or the traditional monetary system of like the banks, right? Which is that
Yeah, yeah.
it's like what gives it its value. So you have this thing called Tether.
Hmm.
So I'm curious if you can explain what is Tether. God, these words like seriously give me a headache. I think a lot of people feel this way. There's so
Oh,
many
you
of these.
bet.
But
It gives
so
me a headache too.
well, so what is Tether? And then where does Ethereum, if I'm saying that right, fit into that? Like, why did Ethereum crash? And what was the significance of that? But I guess first, what is Tether and what did that have to do with it?
Okay, so just before, so the universe of crypto finance, you have, let's say, the coins. So you have Bitcoin, and you have a whole range of other coins, and these are kind of mined through the process of I was talking about. And so, in that sense, there's nothing backing them.
Mhm.
So, the dollar is backed by the creditworthiness of the US state, but any kind of crypto coin doesn't have any backing. It's just, and other than the trust kind of embedded in that code. And it's very, very volatile. Now, the development of a whole ecosystem around crypto, which means you have kind of just like you have traditional finance, you have lending, borrowing, investment. The growth of that in crypto requires some anchor. So just like the US Treasury bill is the anchor of international financial markets, it's the safe space. You need something which is stable, because these prices are so volatile, it becomes impossible to kind of navigate. So that's where stable coins come in, and Tether is one of the most important stable coins. So unlike Bitcoin or other coins, its value is not supposed to fluctuate. It's supposed to remain linked. So it becomes something like Tether is the bridge between, let's say, traditional finance and crypto finance, because it's stable relative to the dollar or some other currency. Yeah.
Mhm.
And it's also the lubricant of crypto finance, because as long as you have this anchor, you keep buying and selling. You have and it becomes, it's just like a stable dollar becomes the basis of
Wow.
um, uh, a whole financial ecosystem. Stable coins like Tether become the tether. They literally tether the So they lubricate it. They allow you to buy and sell, and they give you confidence, and they also allow you to move from crypto to traditional
Mm.
finance. And you can have algorithmic kind of coins which use some kind of code to kind of maintain the stability of the price. But Tether is backed by conventional assets.
Okay. Okay.
It's
And
backed
then
by cash, bills, and a lot of commercial paper, which is short-term kind of liabilities of the private sector.
okay, and then where does Ethereum fit into that? Because there was, a few
Ethereum
months ago.
is a kind of a again is basically it's linked to Ether, and it's this blockchain technology which has been the core of what's called decentralized finance. So one part of crypto is what we call the decentralized distributed ledger, the blockchain.
Mhm.
Another part of it is what's called smart codes. So instead of having instead of having a banker and you sit at the bank and say, okay, this is what I want to do, and this is how it should be invested. This is my risk profile. Here you have a kind of a smart contract where everything is coded and pre-programmed. So it says if price rises above this, sell, for example. And these smart codes need the Ethereum kind of, I use that. So that's the language, call it the language of it or the kind of bedrock of it.
Mhm.
So Ether and Ethereum are critical because they are where the smart coding happens, where you kind of, and the fact that it is can be used across different applications or systems is also makes it, there's interoperability. So it allows you to kind of pre-program and also compose. You can mix and match, you can build on. So it basically creates, doors open up. There's a whole new avenues of making money and speculating, which and that's the importance of Ether.
But so Ethereum actually crashed though, if I'm not mistaken, right? At some
No,
point.
no. So
Oh, it did
it
not.
didn't crash as much. No,
Oh, okay, okay.
Bitcoin did. Tether was the big shock because it's a stable coin, and it's
They're not supposed to
like
crash.
they're not supposed to break the buck. It's like
Okay.
breaking the buck, and it got back. So it wasn't a crash; it was breaking the buck,
Okay.
kind of more like that. And Ethereum, there was the big thing here is there was a change in the technology. The old technology is called a proof of work, where you use this energy guzzling coding to validate. You had this new thing for Ether, which is called merge, where instead of proof of work, you have what's called proof of stake. So instead of having using all this coding, you stake. You put in a stake, and that is basically your skin in the game.
Okay.
So
Okay.
that was the big thing which happened, which was this change, and the idea being this is going to be less energy intensive, and
Hmm.
so we use um, proof of stake instead of proof of work. But it also means that those who have you need to have the stake in order to play the game, and basically game the system too.
I see.
So
I see.
so we are it is, may not be as energy guzzling, but it is inequitable.
Exactly. Well, so you actually bring up in your piece the issues of the impact of the pandemic and then the war in Ukraine. You write, by the end of 2021, the ecosystem of cryptocurrencies had mushroomed to cross $3 trillion, of which stable coins, which you just talked about, constituted $120 billion. Meanwhile, the magnitude of capital within the DeFi sector rose to over 230 billion. Fueled by easy money policies in the wake of the pandemic, this euphoria reached a peak before the global spillovers of the Russian invasion of Ukraine manifested in skyrocketing food and fuel prices, interest rate hikes, and soaring debt burdens that upended the bull run. So, first, what was the impact of the pandemic on cryptocurrencies? Why was that so positive in the world of crypto? And then, why did the war in Ukraine burst that bubble?
Okay, so it's the thing about the pandemic. For those who had kind of continued, it destroyed livelihoods for a lot of people. But for those who did have livelihoods, that there was a peak of savings, right? There was not that much to spend on, and there was this money, and you're all sitting in front of screens. I mean, I know this sounds a bit cliched. So that was a big boom for kind of dabbling in crypto because, and there's also a big boom in crypto fraud during the pandemic.
Oh.
It was this, I mean, um, it was, how do you say, it's so the kind of confluence of savings,
Mm-hmm.
easy money, low interest rates. So there's a lot of liquidity kind of flowing the system. And there's, in response to the pandemic, the Fed is also kind of pumping money in order to keep, I mean, after the collapse of the stock markets in March 2020, the Fed pumped a lot of money. So there's a lot of liquidity, there's savings, and I guess they're bored people sitting in front of their screens, not knowing what to do. I mean, and some are making up scams, so the frauds arose, and some are trying saying, okay, maybe I can make money. So new coins and new kind of instruments are being launched, and it was a bonanza.
Wow.
And of course, the very success kind of bred the grounds for its kind of collapse. Um, and again, um, the war, the breakdown in supply chains, the rise of inflationary pressures, and the fact that central banks, including the Fed, were now switching policy from that easy money to tightening.
Mm-hmm.
It meant there's a change in kind of investment climate. And that general kind of collapse of confidence had its impact on stock markets and also on crypto finance. So I mean, so this is, let's say, call it the macro context. I mean, you can't make a one-to-one kind of causal thing, but this is where things are beginning to change, and that provides the context for a fragile kind of system to begin to collapse. And the collapse of Terra Luna was where it all began. I mean, was one of the big triggers.
Yeah, you mentioned that in your piece, this like what you call unraveling that we've been witnessing that began, you said last May, so May of 2022, with this collapse of Terra Luna. So up
Mhm.
until then, crypto was seen as this like stable asset that everyone should invest in. What happened with Luna and why was that so significant? I actually remember, I still don't quite understand all the, details around it, but I just remember when that collapsed, it was a really big deal on Twitter.
Oh yeah, no, yeah,
Yeah.
no, and it was because just before that, I mean, you had all this part, the Super Bowl ads of "Fortune favors the
Right.
brave," and of course the kind of the
All the
slogan of crypto
celebrities.
brands, all the celebrities
Yeah.
endorsing, and the
Yeah.
slogan of "Good luck staying poor, bro,"
Yeah.
because if you don't get onto the bandwagon, then you're really stupid.
Mm-hmm.
So there was that whole thing, and then as I said, there's a changing macro context, the war, inflationary pressures, changing central bank policy. But um, so Terra Luna is kind of Terra is a kind of a stable coin, but unlike Tether, it's algorithmic stable coin. It's not backed by assets, but there's an algorithm which kind of calibrates its price relative to its sister currency, Luna. So
Mm-hmm.
Luna is a regular coin whose value is volatile, but basically the buying and selling of Luna and Terra uh, allows you to keep the 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 rate between the two stable.
Okay.
But in order to create a market for this, there's also a linked lending kind of platform called Anchor. And just before this collapse happened, they raised their rates of return to 20%, which is mind boggling. And obviously, you can't, I mean, if
The
you're going
big
to
red
offer a
flag.
20% rate of return, where is it? Where are those
I
returns
mean,
going to come from?
right.
So, so that basically set the ball rolling, and people started to get worried because of Terra prices, and there wasn't enough kind of leeway in the system to protect the peg, and people started pulling out the money, and the whole thing collapsed.
Yikes. That sounds
Yeah, but
terrible.
but but at the
If your
heart
money's
was
in
that
it.
20% return. You're trying to, I mean, and that's what was creating a market for Luna. The fact that you could then invest it and get 20% return. But it was a Ponzi scheme, right? You
Yeah.
you get more and more people in, so you have more money, so you give the returns at the beginning, but being able to give the 20% returns depends on continuously drawing more people into the scheme.
Yeah, no, I mean, I'm talking to you from Lebanon, where that's literally what the banking system here was at one point. I think there was interest rates that reached like 20%, and that's when it became
Yeah,
very
yeah,
clear to
yeah,
people,
yeah,
you should get
yeah.
your money out of
Get
there.
your money out.
It's like a red flag for a Ponzi scheme.
Exactly, exactly.
And are there any parallels with that collapse you just mentioned and like the various banking crises and sort of bank runs that have resulted that we've seen since deregulation in the 1980s?
In fact, longer. I mean, this is the bank run is, I mean, from the oldest bank runs, which could have been, let's say, something in England or even before. But I mean, I'll just go back to the 80th century. Yeah, you have this bill discounter who is kind of selling bills which are short-term IOUs, and they're supposed to be exchangeable for cash. Now, if you issue too many of them, at some point you're not going to have the cash. So
Right.
that was an old kind of a run. Then you had banks who have basically taking deposits from people, but in the 30s in the US, this money was put into the through trusts into stock market. So people's deposits were being bet on the stock market. It crashed. Then you suddenly
Right.
find, okay, I don't have the money to pay the depositors, and depositors start lining outside your bank gates, and you just shut the gates, right? Again, in 2008, you had a similar thing, but it wasn't bank deposits. It was what's called the shadow banking system. The way what happens to borrowing and lending through loans and deposits, the financial these shadow banks were borrowing through short-term money markets using commercial paper, using a system of collateralization. You give up, you get cash giving by giving security as collateral and taking it back the next day with a cut. All
Yeah.
these systems were how cash was coming in, and it was being spent, it was being invested in securities, all this huge range of securities, which again were opaque. They were
Like the
had
derivatives.
Yeah, all of that, the collateral debt obligations, the all these what's called financially engineered products. So that I mean, so now when you're not being able to fund your positions by borrowing, when then you suddenly find that you have to pay, but you don't have the assets to pay it with.
Mm.
So that's the classic run, and the same thing happened here. So, for example, Tether had people wanted their money, their Tether in some other currency, but the Tether had to sell the commercial paper and other assets it had on its balance sheet in order to make that good. But if everyone's pulling it out, it's going to be hard to sell those assets
Right.
at value, right? So
Yeah.
that is a problem.
Yeah.
So in that sense, it was some of it is just old stuff, old hat, in many ways.
And what's the importance of collateral in this case?
So the thing is, in relationship banking, uh, reputation, etc. So you have unsecured banking, where you don't post collateral. It's your trust in the, I mean, it's a big bank or whatever. But collateral is used whenever um, you don't have a way to monitor the person whom you're lending to. The collateral acts as a standby. Now, in the trustless kind of permission, or rather the permissionless world of crypto finance, collateral plays a big role. It played a big role in shadow financing because every time you want cash, you post a collateral. If that collateral's price falls, then you have to post more, and you can get
Hmm.
less cash. If the price is rising, you're able to get more cash. So collateral is in that sense, in an upswing, it kind of stokes it, and a downswing, it kind of acts like a downer. So it's what's called pro-cyclical. It amplifies uh, volatility in both cycles. Now, in crypto, collateral plays an even bigger role because we don't have it's permissionless. You don't know who the person is, anonymous. How do you kind of have trust?
Right.
So a lot of crypto lending is over collateralized. So instead of having, if I have a loan of 100%, I need of $100, I need a collateral of $100. Here you would have collateral of 150, for instance.
Okay.
So you're posting a lot more collateral as in order to kind of make
So
up for the fact that it's permissionless.
so
And
you have more to lose in a way.
in a way, if the prices crash,
Yeah.
you have to post more. And now the other wrinkle is because it's kind of crypto and everything is kind of based on code. Instead of having a bank saying, "Hey, the prices have fallen, your collateral is now worth less. You need to post more or do something or repay back." Here you have a bot which is going to be trolling to find, okay, here, hey, this particular person's collateral has fallen in value, and if it falls, kind of below a certain level, then you liquidate it. And the incentive to do this is because you get a cut.
Okay.
So you have people, apart from miners who are kind of validating transactions, you have coders who are kind of who are trolling to find such liquidation contracts automatically.
Okay.
So and that's the important collateral. It makes it more fragile because it increases volatility,
Okay.
and it's pro-cyclical. Yeah.
Well, so how do we understand what happened with someone like, oh, this is the exciting stuff now, someone like Sam Bankman-Fried, which I know everyone who's watching knows who that is because he's been all over the news for the last
Yeah.
2 months, right? It's quite like a crazy story about him and his partner and just all of the crazy things they were doing. But yeah,
They're
how do
going to
we
make a movie on this at
yeah,
some point.
they of course. But like, how do we understand what happened with a figure like Sam Bankman-Fried and his FTX in the context of what we've been discussing?
So the rise and fall is truly spectacular. I think his empire was worth like 36 billion or so about and it kind of tells you, everyone kind of, the con is kind of mind-boggling, and it kind of reveals the Ponzi nature of crypto finance. But uh, uh, the story is also kind of the lessons are there because apart from the money he made, he was also being touted as this new JP Morgan like figure who, like, if JP Morgan in 1907, the panic in the US financial markets, had stepped in and created these with these financial lifeboats to get the system back in order in 1907 by kind of organizing a fund to basically bail out the banks. Um, this Sam Bankman-Fried did the same with his FTX and Alameda pumping kind of into Voyager and other companies which were collapsing by putting money in. But it turns out that the biggest problem, the history of finance is a history of such cons, and it's a history of how kind of law responds and you set up regulatory mechanisms. Now, crypto is still the Wild West. The regulatory mechanisms are not there. So, just like tethered, a bank has to have its balance sheet basically audited, but something like stablecoin doesn't. It can just present a snapshot and say, "See, I look good." Sam Bankman-Fried, neither Alameda nor FTX, the exchange, needed to show their balance sheets, or basically uh, there was no regulation. So, and it turns out that basically uh, funds were being lent out. The money was being deposited by one arm and lent out by the other with no transparency whatsoever. So, and more recently, there's the stories about how even the Terra Luna collapse, some price manipulation role may have been played by investments of FTX. So there's all this. So the name of the game is you talk up a particular thing, get people to put money in, and then um, you had the classic rug pull where after getting the money in, you just disappear, and there were a lot of crypto people like that. Or you have the FTX kind of thing where you didn't disappear, but you thought you kind of uh, attempted to enter the mainstream. Along with other kind of crypto people, you're lobbying, you're putting money in, and you're trying to actually control, kind of have a say in the discourse on how the crypto is going to be regulated.
Right.
So after having kind of positioned himself like that, this fall is completely kind of was kind of basically put a spanner in the works in a sense, and
It is truly astonishing to watch.
it's
But
truly
does,
astonishing. But if you
does it
think so
raise?
astonishing, but there's the story is more. Apart from FTX, you have these other. So Three Arrows was one of the earlier companies to go bankrupt when after Terra Luna collapsed. Now, the co-founders of that, along with the co-founders of another kind of crypto fund called Coinflex, I think. Um, so what they've done is that now, having bankrupted their old institutions, they are now touting a new thing where the bankruptcy claims are being marketed. So if you buy them, you can have the option of making it into equity or a debt, but they are
Wow.
now trying to. I mean, every crisis is an opportunity, right?
Jeez, like, seriously, wow.
So that's
Okay.
so yeah, that's happening. Hmm.
Well, so that raises the question of, how many Sam Bankman-Frieds are there? Was this something that was exceptional and just, unique to him? Or, is this something that's maybe a part of the sort of crypto world that's more common than we
Not, I
think?
think it's part of the finance world, not just the crypto world.
Okay.
I mean, you had Madoffs, you had Ponzi's, you had,
Right.
I mean, the what like you had people like John Law long time back who were both kind of created the first template for a central, I mean, a kind of a banker's bank, but also had was chased around Europe because because the schemes were kind of falling apart. So, and that is why I mean, finance has this inherent tendency.
Mhm.
I mean, and especially when there's easy money policy, it's interest rates are low, people are kind of wanting to make money, and you feel silly if you don't because everyone else seems to be making so much money. You have kind of young, like 20-year-olds sitting in front of the screens and suddenly becoming overnight millionaires. You it's very heady, and but it's not doesn't have real foundations, and
Right.
which is
Yeah.
why every financial innovation in parallel you have to develop the regulatory apparatus.
And then that's what he was doing. He was lobbying. I mean, there was a lot made in much of the media about how much he had given to the Democratic Party, but that was all
Yeah,
just
yeah,
an attempt to buy influence and lobby regulators, right?
absolutely,
So that
absolutely,
to prevent regulation of crypto.
yeah.
Um, I
And
wanted to
again,
ask. Oh, go
that's
ahead.
not kind of limited to crypto. All finance, I mean,
Right.
the lobbying by finance, let's say, to prevent derivatives from being regulated. There's,
Exactly.
there's a whole story of that before the crisis of 2008. So it's an old story. I mean, you want the free finance wants the freedom to kind of make kind of venture into new grounds, make lots of money, while policy has to kind of put in the guardrails.
And then, of course, this pokes a huge hole in the entire narrative that we hear about cryptocurrency. And this brings me to the issue of the sort of libertarian tech gods that are behind the ideas of cryptocurrency saving the world. And you write in your piece, belying the pipe dream that these decentralized, trustless, anonymous, peer-to-peer, blockchain-enabled mechanisms can be wielded to challenge the stronghold of big finance and big tech, crypto finance has merely expanded the hunting grounds for the speculative vampire squid of finance. And I think that's such an incredible, like an important point, because the libertarian origins of these digital currencies, that should have been a huge red flag. The idea that like Bitcoin can get around this big bad government and the central banking system,
Yeah,
that cryptocurrency can be this like bulwark against the Federal Reserve, as you mentioned. And a lot of these, it's just completely untrue. It's just another version of that same system. But
absolutely.
a lot of these like tech gods who promote this stuff, they speak in these really pretty sounding utopian terms, even when their motives are just money and power and fame. Can you talk a bit about the danger of this notion that tech companies and their owners can do good or like be responsible for our salvation, whether it's like hunger or environmental issues, that it can all be found in these companies and in digital
Yeah,
currency?
yeah. I mean, it's quite it's mind-boggling how deep this kind of I mean, it's like those snake charmers. right?
It's a good comparison.
Oh, yeah, they, no, and I think part of the, um, I mean, technology is not socially neutral, right? Technology, the way it operates, the way it is executed, depends on the social context in which it's being executed. And this notion that you have technology above people or beyond kind of any kind of the motivations which kind of shape social relations is absurd.
Mm.
And it's and you can see it. I mean, so you see it in some things like Theranos and the selling of, the ability to, I mean, this appeal to this quick, I mean, making these quick rich, getting rich quick kind of schemes is very, very kind of pervasive. And I mean, it's not just our time. I think it's there historically, but in our time, it's the the reach is truly spectacular, partly because of social media. You can amplify the voice really fast,
Yeah.
and and a lot of these kind of Ponzi schemes depend on that amplification because you want to draw in the maximum number of marks.
Right.
I mean, yeah. So,
Well,
and that is, uh, so again, now, so the idea being that blockchains can solve every problem, they can decentralize, but it's and the hubris, I mean, there's a hubris of saying technology can solve all problems, but there's also kind of deep obfuscation in saying that this is democratically enabling, empowering. It's not, because technology, especially kind of big tech, becomes a way of monetizing everyone's daily lives, turning them into a money making machine. Your data,
mhm.
where you shopped, where you kind of stopped, which turn you took, all of that becomes a data which is then monetized and becomes part of, this whole concentration uh, of money. And so you can imagine a universe where financial technology and big technology are merged, and it's truly scary. It's not just, it's the surveillance aspect, but it's also this capacity to really expand control and um, extraction of resources.
Yeah. Yeah, that is
Yeah,
frightening.
yeah. And now greenwashing. I mean, you have, yeah, there's a whole story of greenwashing of bonds, but now again, uh, crypto is seen as the panacea. We can use this technology to make it more transparent. We can use it to kind of, make it more accessible and actually, trace. But it's just adding one more layer.
A
Hmm.
capitalist scheme to fix the problems of capitalism and then create more. You also mentioned how these, and I'm quoting you again, that big asset management funds led by BlackRock, which recently announced a tie up with Coinbase, are set to invade the crypto sphere. Institutional investors are increasing their exposure to crypto assets. Goldman Sachs, Citigroup, and JP Morgan Chase have been wading deeper into the sphere, undeterred by the convulsions. The crypto winter is paradoxically also heralding the rising clout of leading crypto financiers and the induction of crypto into the mainstream of finance. So I raise that to ask you, if so many major financial institutions are investing in this digital funny money, when it collapses in the future, could it potentially affect the actual financial system around the world?
Absolutely. I mean, so far, even though I mean, the footprint has been limited, uh, but with the increasing involvement of kind of these financial institutions, and depending on the scale of the involvement and how fast it grows, it could kind of, the repercussions would be much more. I mean, one talks about too big to fail institutions, and the whole thing is really about the network effects, how networked, interconnected you are.
Mm-hmm.
And part of the crypto world is still fragmented, but as the mainstreaming of crypto means that this fragmentation is going to be broken, is going to be more integrated into conventional finance, which means that I mean, any kind of weak link here is going to have repercussions beyond the crypto world in the world of traditional finance. I mean, it could happen, for instance, when a stable coin is trying to, is backed by by treasury bills or by commercial paper. In order to, when there's a run, it tries to sell. Selling means the price of commercial paper goes down.
Mm-hmm.
And if something like Tether is a big player in the commercial market, it's going to have repercussions on all the financial institutions who are kind of in part of the market. Similarly, if banks are kind of JP Morgan, Goldman Sachs are entering into kind of setting up their own crypto funds, when there's a collapse, their balance sheets will be affected. But again, just like in the in the 2008 collapse, what happened is you have shadow banking around conventional banks.
Mm-hmm.
But when shadow banks were kind of unraveling, the big banks had to step in. Had to extend the lifeline. But when they found they didn't have the capital to do that, they turned to the Fed.
Mm.
So the same thing, if it becomes too interconnected and too big, then the Fed may be forced to step in.
So you also mentioned in your piece that tokenization, which is this digital representation of conventional assets enabled by blockchain technology, is not limited to financial assets. You've got digital tokens that can represent real estate, like art, and even high-end wine and whiskey. That surprised me. I knew about the art, which I think that has something to do with NFTs.
Yeah,
but I
yeah.
didn't know
Yeah.
I didn't know high-end wine and whiskey could have some sort of tokenization attached to them.
Yeah. No, so it's just like you can make a house into a financial asset. You can
Mhm.
make a chair into a financial asset.
Okay.
Now you're adding another layer, you're digitalizing it.
Okay. So then what do these
So think of it, there's a house. I
Yeah.
do a mortgage. The mortgage becomes a collateralized debt obligation, which is
Mhm.
on top of the collateralized debt obligation. You could say I have a digital fractional claim on that CDO. So you're adding layers and layers which are separating you from the real thing, whether it is, tokenization could, whether it's the high end whiskey or the house. There's tokenization in the real estate, your deposits, bank
Okay.
deposits. So it's crazy, but the mantra of finance is if you could find a way of making a quick buck,
Mhm.
go for it.
So other than just sounding completely absurd, which it does,
Yeah.
it does. It sounds so absurd that I'm gonna like take
No, but they're
something and
biased for it. The kind of attraction is that now, instead of buying what you're by tokenizing it, you're getting a fractional claim in this. Let's
okay.
say it's $1 million worth asset. You can't pay $1 million, right? But
Mhm.
tokens break it up.
Okay.
So just like securitization made something which is fixed and illiquid, like a house, into something which is liquid,
Yeah.
tokenization makes something which is kind of also makes it's still liquid, but it also gives you a fractional claim. It breaks it up,
Okay.
allowing more ostensibly allowing more people to have a share of the cake or the whiskey, whatever.
Well, so the whiskey. So what but is okay, so that's what they mean, but then is there a danger to this? Is there any sort of danger to this?
Of course, there is,
Oh,
because the thing about every financial instrument is sometimes it's innovated as a way of creating liquidity or creating safety,
okay.
but its use tends to become speculative, like derivatives. Derivatives are meant to hedge against kind of fluctuations in interest rates or exchange rates, but they ended up being speculative in their own right. Similarly, tokens are meant to, tokens are being kind of also pushed in the regulatory sphere as a way of rooting crypto, which is basically rooted in thin air, into something more tangible. It could be a bank deposit, it could be a painting, it could be, so there's something real it's linked to. So it's being pushed as a way of grounding it.
Okay. I see.
But the repercussions, I mean, uh, could go the other way.
Of course.
Yeah.
So I just have a couple more questions here for you. And one thing I wanted to ask you about, you reference this very briefly in your piece. You say that the digital terrain is likely to be a battleground where China tests and challenges the global hegemony of the dollar. I thought that was kind of interesting. I was wondering if you could elaborate on this. And moreover, how digital currency might fit into the new Cold War that is shaping up more and more with each passing day between the US and China.
Yeah. So the thing is, in international monetary systems, I mean, right now the dollar is dominant currency, and it is dominant because it's the critical hub where transactions are being centered. So it's used in foreign exchange transactions and investment, lending, all of that, and not just in trade. Now, in order to kind of now China has been pushing digitalization more in the domestic sphere, and in part it's kind of it's been seen as a way of China, the Chinese state, trying to cut the big tech like Ant and all Alibaba, all these companies down to size, and basically asserting the state control over big tech. But the same technology, I mean, the critical thing here is now, I mean, what's called the first mover advantage. The same technology can be built to kind of explore the global space. And already with I mean, there's been this thing called M-Bridge. So it's Thailand, Hong Kong, and the UAE. They've created a wholesale clearing system for cross-border payments for digital currencies. Now, it can turn digital currencies into tokens, which can be exchanged between banks across countries. So this hub is an important hub. Again, the China has this called a blockchain-based service network, again, backed by the state, using this the startup has helped with the technology. Now that aims to make basically it's being developed into a new universal digital payments network, which is going to be used to make digital currencies more easily traded across for cross-border payments. I mean, the name of the game in the international sphere is the fact that digital currency and this technology can make cross-border settlement secure and fast.
Okay.
So if you are ahead of the game in the technology, then you're ahead of the game in being the center of the network. And that's why kind of the US government is also kind of starting to push on this and saying that we need to stake our ground in this technosphere. And the sanctions on Russia after its invasion of Ukraine also created all this thing about alternative ways in which these sanctions could be circumvented, and part of it is the crypto terrain, right? And creating alternative system like the SWIFT system, which is monitored by US and European banks. So that's hard to circumvent interventions. I mean, the sanctions can be implemented more strongly there. But outside that, if you have these alternative cross-border payment systems, then the ability of the US to control payments would be undermined. So this is a terrain where I mean, it's hard to say what's going to happen, but it's obviously, I mean, China has already kind of pushed ahead. The US is now kind of becoming more conscious of the need to kind of forge its own ground. So so that's the sense in which there's a terrain for
a few for the Cold War that's already developing.
And what's called, I mean, so the war being fought by other means.
Yes.
So through finances and the financial hegemony is a key way in which the global order is structured. And so,
and then I guess the last thing I'd want to ask you about here is the fact that I'm curious, like, what is the point of what I think, or from what you're explaining, sounds to me like very fake money. Although I guess in some ways, a lot of money is just fake, right? Like it's, I mean, this really does speak to like a lot of the problems within the system of finance in general, which you've mentioned. But what's the point of this particular kind of fake money? Like if you can't, because with cryptocurrency specifically, you can't buy food with it. For the most part, you can't buy shelter with it. Or I mean, I can't go buy clothes with it. Most malls you go to, like you can't pay in cryptocurrency, at least not yet. And it doesn't seem like it's going to be the case anytime soon. So what's the point of it if you can't actually use it to purchase things? Is it just purely for speculation and gambling in this kind of casino marketplace? And then, is this like capitalism's dying breath in a way, as like people try to squeeze just profits out of this system that, isn't actually producing anything anymore? It's just moving numbers on a screen. Like, what stage of capitalism is this?
Well, yeah, it is. It is. I mean, it does feel very, very dystopic, right?
Yeah.
But the thing about and the thing about capitalism is that the things which, I mean, um, its vulnerability is also its resilience. So one shouldn't underestimate that. And
Of course.
every crisis becomes an opportunity, and every barrier, obstacle becomes something to surmount. So financial innovations basically are, are ways of, let's say, relaxing constraints on investment or spending, but they acquire a life of their own and become something for its own end. And while something like a share or a stock is still rooted in something real, it's related to, let's say, a company's balance sheet. The thing about crypto was that it 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 has made the connection even more tenuous, because it's I mean, something like Bitcoin, and it's completely disconnected, right? And you're right, it cannot be a means of payment because it's so volatile. It does become a store of value because of volatility. People make bets, someone loses, someone wins,
Yeah.
and there are always people who think they can win.
Right.
And as long as there are kind of suckers out there who are drawn to the games, you make them winning. So that is the life. I mean, that is why finance grows, and it's this double-edged sword. It's essential. You need it to buy your house, to kind of all those reasons. You need it to invest. You need it in terms of in plant equipment, factories, whatever, a business. But it's also something which through innovations is appears to be creating its own returns.
Yeah.
And that is the alchemy, and that is what kind of let's say, the smoke and mirror of finance. And that's where the problem lies. And that is as old as capitalism and beyond, even before that. But it has reached a point right now where, let's say, the share, I mean, and that's what people call financialization, the share of resources being kind of diverted to finance have become really disproportionate. But this is capitalism's logic,
Yeah.
that finance first becomes a way of fueling accumulation, real accumulation, plants, equipment, factories, houses, whatever. But then it becomes something more and more feeding off itself. It has this reflexive character.
Well, Rama, I really want to thank you for taking the hour to break all this down for us. And I want to encourage anybody who's listening or watching to go check out your piece at the Monthly Review. Once again,
Thank
it's
you.
called really, really excellent, wonderful, in-depth piece called Crypto Convulsions, Digital Delusions, and the Inexorable Logic of Finance Capitalism. I will link to it in the description. Thank you so much for joining me.
Thank you so much for having me. It's been a pleasure.
Thanks for watching, everyone. If you want to see more progressive anti-imperialist content like this, make sure you hit the subscribe button so you can stay up to date with the latest breakthrough news content. And if you want to support our work and get access to exclusive content, head over to patreon.com/breakthrough news.